Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, April 11th, and you're tuned into a special edition of On Trend. It is special because I'm actually on vacation this week, and also this is part 2 of a series on using RSI for trend following and momentum strategies. Part 1 was on Tuesday, April 9th, and today we're going to expand with some testing. So we'll start off with a little recap of what we talked about on Tuesday. Then we're going to get into testing. We'll test RSI bull and bear range signals, RSI bull and bear momentum signals, and then we're going to combine those signals to see what we get. And we'll finish with a summary and some key takeaways. You can also check the Arts Charts commentary for Monday, April 8th, and there you will find links as well as some scan code on these trend following and momentum strategies. So in the previous video, I showed that there was a paper from D'Souza and his colleagues, and he showed the enduring effects of time series momentum, which is also the same as trend following, on stock returns over nearly 100 years, an 88-year period since 1927. He showed it to be a persistent phenomena in the U.S. equity markets. Furthermore, I also showed a paper from Jagadish and Titman where they discussed momentum and tested momentum theories. This is a follow-up to a previous paper, and they showed that the momentum strategy still worked on stocks overall, but it did suffer a setback in 2009. And putting trend following and momentum together, Gary Antonucci wrote a book called Dual Momentum Investing. And basically that is buying stocks that are in uptrends and show strong momentum are leading. And there's a quote there from Richard Dryhouse: "I try to buy stocks that have already had good price moves, that are already making new highs, and that have positive relative strength." So I also went into detail on the formula in RSI and how it works, what are the key drivers, and the takeaway is that when RSI is above 50, that means the average advance is greater than the average decline over that 14-day period, and prices are typically advancing. And then you can see here when RSI moves below 50 and stays below 50, prices are generally declining. And so that is what makes RSI a trend following indicator. So when it's above 50, that favors an uptrend. When it's below 50, that favors a downtrend. And when you get above 70, or the further above 50 you get, the stronger the uptrend. And the further below 50 you get, the stronger the downtrend. RSI is also normalized. The indicator fluctuates between 0 and 100. And this is very important because it means we can compare internal values. In other words, we look at one stock over a 1-year period and we can see how the RSI range shifts. Also, we can compare RSI values externally. So we can see which stocks have the highest RSI ranges, they are outperforming, versus the ones that have the lowest RSI ranges, they are underperforming. So as far as the testing stocks in the period, we're going to use the stocks in the S&P 500. And I'm going to use total return data, which means the dividends are included in these returns. And that's important because we're using a 20-year testing period. We're also going to use historical constituents to prevent a survivorship bias. So that means if a stock was in the S&P 500 in 2005, it will be part of the test. But if it was not in 2015, it would not be part of the test in that year. I used Amy Broker for testing, and the data comes from Norgate Premium Data. So here's what the S&P 500 looks like over this 20-year period, and there are at least 2 market cycles here. You can see a bear market, 2000, 2002, a bull market, 2004, 5, and 6, and then another bear market and another bull market with some big advances. So we've captured a number of different market environments during this testing period. If you look at the chart below, it's the S&P 500 Total Return Index. It's a performance chart, and you can see it was up 198% over this 20-year period, and that's a compound annual return of 6.1%. So clearly, there's a bullish bias over the entire 20-year period, but within that period, there were 2 bear markets and there were a couple of pretty sharp declines as well as some volatility. The question I'm going to answer is, do these RSI range and momentum indications have any predictive value, and can they be used as part of a successful trend and momentum strategy? And to answer that, we're going to use 14-day RSI, which is the default setting for RSI to test these signals. So basically, if RSI holds its bull range for n number of days, say 75 days, we would buy. And if that trend extends, we'll keep holding until RSI breaks below that range. And we'll test to see if that would be profitable. Similarly, if RSI moves above 70, we're going to buy. And we're going to keep holding that as long as RSI moves above 70 within n number of days. Say every 75 days, if RSI keeps moving above 70, we keep holding. And we'll see if that has any predictive power. Now, the signals are based on closing prices. The buy and sell are on the next open. There are no commissions or slippage. And I'm just using a simple percentage change, but I'll also show you the average number of days for these trades as well. All right, so now I'm going to provide an example of a bull range signal and one that worked and one that didn't work. And so basically the bull range signal triggers when RSI holds above 40 for 75 days. And once it does that, a buy signal triggers and it remains in force until RSI moves below 40. So here we can see F5 networks, and there is RSI above 40. And you can see during this period, it did not dip below 40. So it's basically in this bull range from 40 to 80, as was put forth by Constance Brown and Andrew Cardwell. So once it held this range for the entire 75 days, a buy signal triggered. And that's what we want to know, is if these ranges have any predictive power. So we can see when the buy signal triggered, we held this range for a few more months, quite a few more months, and then dipped below 40 there in June. And so between when that buy signal triggered and when RSI finally moved back below 40, you had a 31% gain for F5 networks. All right, here we have an RSI bull range signal for TripAdvisor. You can see RSI moving above 40 there in the latter part of November, and then holding above 40 for 75 days. There's the green dashed line for 75 days. So that triggers a bullish signal. And then you can see RSI move below 40 a little over a month later, and the stock was down. So this was a failed signal. So here's a table testing the different RSI bull range look back periods. You can see we start at 25 days, 50, 75, which was the example I showed, 100 days, and 125 days. So that means RSI must hold its bull range for 125 days. The signal triggers and it stays valid until RSI moves below 40. And so testing these stocks in the S&P 500 over a 20-year period, you can see there's a lot of signals, but the longer the period is, the fewer the signals there are. The success rate was in the mid to upper 30s, which is well below 50%, not that great. You can see the average advance is bigger than the average decline. And if you divide those two, you can see that basically the profit-loss ratio, which is the ratio of the advances to the declines, is well above 2. So that's really good. That's what we want to see, a high profit-to-loss ratio. And then we have the average days held for an advance was around 80 days, and the average days held for a decline was around 21 days. So pretty short term on that. So let's look at the RSI bear range signals. This is an example of a bear range signal. So basically RSI needs to hold below 60 for 75 days. So there you can see it moves below 60. It holds for 75 days at the red dashed line there, and that's when the signal triggers. And here for Dish Networks, if you had sold or sold short, you would have had a subsequent decline of 30% there, because it took, that's how long RSI stayed below 60 and prices trended lower. And there you can see the signal ending when RSI moves above 60. So here's another example of a bear range signal, and this one failed, and I'll show you why. You can see that RSI moved below 60 there, and it held below 60 for 75 days at the red dashed line, and so that established a downtrend. And so if you had sold there and held until, or sold short, and held until RSI moved above 60, which is the green dashed line, you can see that would have been a losing short trade because the stock advanced 12% after that. So this is a failed signal. So here are the results when we use the RSI bear range signals for the S&P 500 stocks over this 20-year period. So we start with the 25-day bear range, and we go all the way down to the 125-day bear range. And you can see the success rate is much lower than we got for the bull momentum signals, around 25 to 28%, very low success rate. Now we can see that prices did decline more than they advanced, so there was a positive expectation as far as the profit-loss ratio. You can see the profit-loss ratio varied from around 2 for the short-term signals, but once you got longer term, the profit-loss ratio deteriorated. And you can see the average days held for a successful signal, which was a decline, were in the 63 to 70 area, and the average days held for an advance after a bearish signal, which was a failure, was around 1 month. Now we're going to move to the momentum signals, and we're going to start off with bullish momentum. I'll just recap why 70 and 30 are really key levels for RSI and momentum. So I showed this example in the first video. This is an example from David Cox, CMT, and he noted that you get these momentum signals. See Apple continuously moving below 30 for RSI as the downtrend extends. And then you have this move from well below 30 to above 70. And that signals a really sharp shift in momentum. And you can see RSI moving above 70 again in October and there in November, December as Apple moves higher. So basically that surge above 70 is significant because it shows strong upside momentum. Now here's another example that I found. It's Eversource Energy, and you can see that it was trending lower with RSI moving below 30. And then you had that big shift from well below 30 to well above 70. And that signaled a bullish change in the momentum dynamics. And here you're moving above 70 again and almost above 70 again there as the stock moves higher. So now we're going to move to the momentum signals, and we're going to use bullish momentum and bearish momentum. And we're going to start with bullish momentum. So a bullish momentum signal triggers when RSI moves above 70. That shows exceptionally strong momentum. And as long as RSI continues to move above 70 within a 75-day period, as it did here, you can see that we'll remain in that bullish signal, even if it moves below 30, as long as we keep moving above 70. But then if we have a period where RSI does not move above 70 for 75 days, in other words, bullish momentum stops, then we will have a sell signal. So you can see there is the initial bullish signal when RSI moved above 70. And after not moving above 70 for 75 days, you get the bearish signal there. And in between, we had a 16% gain for PNC Financial. Here's an example with eBay, and you can see RSI moving above 70 there to trigger a bullish momentum signal. And here's RSI not moving above 70 again. And once it gets to that 75-day period without moving above 70, that is a failed signal, or basically that signal has reversed. So if you had bought when RSI moved above 70 and then sold after that 75-day period when it failed to move above 70, you would have ended up with a loss. And I want to show you a successful signal and a failed signal because not all signals are successful. So here are all the momentum signals. And there you can see we start with 25-day momentum. So that means RSI moves above 70. And as long as it keeps moving above 70 within a 25-day period, that signal remains valid until it stops moving above 70. and we go all the way down to 125 days, which is basically 6 months. So if RSI moves above 70 every 6 months, that signal remains valid. And you can see the success rate is pretty good. We got above 50%. So we got a really strong success rate. You can see that the average advance is greater than the average decline, but the profit loss ratio is not that strong. You don't get above 2 until you get to 125-day momentum. And then you can see the average days held. Well, that extends as the RSI time frame extends for the bullish momentum. And you can see that the average days held is less. So your losers tend to be roughly 2/3 of the time held than the average winner. Now we're going to test the bearish momentum signals, and that's just the opposite of the bullish momentum signals. So basically, if RSI moves below 30, a bearish signal triggers. And as long as RSI keeps moving below 30 within a 75-day period, which is the look back period in this example, the bearish signal remains. And it reverses when RSI fails to move below 30 over that 75-day window. So we can see RSI moving below 30, signaling a strong downward momentum thrust. We got a bounce in the stock after the thrust, but you can see RSI hit 30 in September again, below 30 in November, below 30 in late February, early March there as prices decline. And then we have this 75-day window where prices did not, or RSI did not go below 30. And once that 75-day window finished, you got your signal to cover if you were short. So if you have been betting on the stock going down in August, you would have had a 13.3% profit because once the signal stopped working, the stock was down. Now, you're not going to get the exact top or the exact bottom, but you caught the meat of the move, so to speak. So here's an example of a bearish momentum signal, and we can see RSI moving below 30 there, and again about a month later to validate that signal. But then we have a 75-day period here where RSI does not go below 30. And once that 75-day period ends, the signal is reversed. So if you've been betting on the stock going down here at this point in February, you would have been disappointed because before that signal ended, the stock went up 25%. So this is an example of a failed signal. So here are all the bear momentum signals as tested. We start with 25-day bearish momentum and all the way to 125-day bearish momentum. The charts I showed you use 75-day bearish momentum. So we can see that the momentum signals, the success rate was a little better than the bearish range signals, but it's still well below 50%. Once you got a bearish signal, the average decline was more than the average advance after that signal, but not much. And if you had been shorting on these signals, your profit loss ratio would be just above 1. So you can see that this is not a very valid system or technique because of the relatively low success rate and the low profit loss ratio. So looking at those tables, it's really hard to compare these signals and how they work relative to each other. So I put all these results on a scatter plot. And on the y-axis, we have the success rate. In other words, what percentage of these signals were successful. If you had a bearish signal and a decline resulted, that was a successful signal. If you had a bull signal and an advance resulted, that's a successful signal. And on the other side, if you had a bull signal and a decline followed that, then that would be a failure. And then on the x-axis, I have the profit loss ratio. So ideally, what we want is we want a high success rate above 50%, and we want a high profit loss ratio above 2 and preferably more towards that 2.5 area where we're getting 2 times profit for every loss. And so if we look at how these signals group, we can see these are the bear momentum signals there on the left in red. And so they have a low profit loss ratio, and you can see they're below 50% for the success rate. So that's no good. And then we have the bear range signals, and you can see that they have low success rates. We get some higher profit loss ratios on the short-term bearish signals, but still with those low success rates, it's really not that interesting. And then we look at the bull range signals, and they have a really nice profit loss ratio. It's at the right side in that 2.3 to 2.6 range for the profit loss ratio. So that's very positive, but it's a low success rate. It's well below 50%. And then we look at the bull momentum signals, and they have the high success rate. All of them are above 50%, but you can see the profit loss ratio is below 2 for most of them. So that kind of dampens that one. So what I think we need to do here is we need to combine the bull range with the bull momentum. So the bull range momentum is keeping with the theories that I showed you at the beginning, where there is evidence that trend following works for stocks. There's evidence that momentum works for stocks. And as Gary Antonacci showed, there's evidence for dual momentum investing, trend following and momentum. And that's what an RSI bull range momentum signal is designed to capture. So if we look at this chart here, we can see we get a bullish signal when two things happen. First, RSI has to hold above 40 for at least 75 days. And within that 75-day period, RSI needs to move above 70. So it's holding above 40 to keep that trend from having the dips being too deep, and it's moving above 70 to show strong upside momentum. So that triggers a bullish signal when those two happen over a 75-day period. And this signal stays valid until both of them trigger bearish signals. So what happens is if you within a 75-day period have RSI moving below 40 and failing to move above 70. So you're losing upside momentum for 75 days and you're seeing accelerated momentum on the downside. That's the sell signal. And if you'd used this for Harris Corp and bought when you had a 75-day bull momentum signal and sold when that ended, you would have had a 24.6% gain on that advance. So here's an example of a failed bullish momentum signal. So again, we have the bullish signal because we have this 75-day period, which is the green shading. And you can see during this 75-day period, RSI did not go below 40, which is a red line, and it moved above 70. So we got our bullish signal at the end of 75 days to buy. And then you can see over the next almost 75 days, a little longer, we can see that RSI did not move above 70, so upside momentum was failing. We weren't getting that upside momentum we needed. In addition, you can see RSI was moving below 40, so we were getting downside momentum as well as failed upside momentum. So after a 75-day period, you would have gotten the sell signal, and you can see that resulted in a loss of almost 20%. So here's a table showing the RSI bull range momentum signals, and we start with 25-day bull range momentum, and we go all the way down to 125-day, which is 6 months. And you can see you got lots of signals at 25 days and only 2,048 signals for 125 days. So over a 20-year period, that's around 100 signals per year. If we look at the success rate, this is interesting. You start at 45% and you get to 57% as you get to 125 days. You got above the 50% threshold at 75-day bull range momentum. If we look at the profit loss ratio, you can see that it got above 2 once we got to the 75-day threshold for bull range momentum. And there you can see the average advance going from 13% to 31%. And the average decline going from around 7% to 13.5%. And as far as average days held, you can see that the average days held for an advance were many more than the average days held for a decline, around half the number of days for a decline as far as the holding period. So here's an updated version of the scatter plot. So we've got the profit loss ratio in the x-axis, the success rate in the y-axis, and you can see the previous bull range and bull momentum signals. And then I've added bull range momentum here. And look at 25-day bull range momentum. It has the highest profit loss ratio and the highest success rate. But we can also see that these other bull range momentum signals, 75-day and 100-day, are having profit loss ratios above 2 and success rates above 50%. So this is the sweet spot as far as the RSI signals are concerned. So in summary, you can see that the bearish signals really aren't worth the time. All right, they were all with relatively low success rates and low profit loss ratios below 2 for the most part. RSI bull momentum, high success rate, but not such a good profit loss ratio. You can see below 2. And the RSI bull range signals had the high profit loss ratio, but the low success rate. And when we combine range and momentum, you can see we get into that upper right-hand corner of this scatter plot, which is where we want to be for a indicator to use in the future to identify stocks with strong uptrends. Now, I mentioned at the beginning that these RSI values are comparable, and this is very important because if you're looking at the stocks in the S&P 500, you can use these RSI ranges to separate out the contenders from the pretenders, the strong uptrends from the weak or downtrends. And if you look at AbbVie and Abbott Laboratories here, you can see a clear difference in these two RSI plots. Now, I talked about the RSI bull range, and it's not perfect, all right? Here you can see Abbott is moving above 70 on a regular basis as that uptrend extends. And it had a few dips below 40, which is the red line, but it didn't go below 30. So this is not a perfect indicator, but I was just showing an example of how to use RSI to compare and find strong stocks. If you look at AbbVie here on the left, you can see a big difference. You can see RSI was moving above 70 on a regular basis, and then it started moving below 30, and it couldn't get back above 70. Yes, it got above 60, but it did not get above 70. And so if you just compare these two RSI values, you can see which one is the leader. Clearly, Abbott is leading, and which one you want to avoid, which would be AbbVie. So our key takeaways: RSI bear signals do not add value or do not have profitability over long periods of time. The RSI bull range plus RSI bull momentum signals do add value. There appears to be a sweet spot in that 75 to 100 day range for these signal periods. And you can get above a 50% win rate when you're using 75 or more days and a profit loss ratio that is greater than 2. Now, nothing is perfect. Whipsaws are going to happen. Maybe you can use 35 as the lower end of your range. And you can also consider adding a 200-day moving average as a filter. In other words, require the stock to be above its 200-day moving average as well as be in that RSI bull range and momentum window. All right, so that concludes this presentation. Remember, you can check out the Arch Charts commentary from April 8th to find more information. Thanks very much for tuning in, and have a great day.